By March 2026, the global financial architecture underwent a structural recalibration, replacing legacy mechanical vaults with a luminous digital grid. The Bank for International Settlements, or BIS, documented this shift. The BIS is an international financial institution that acts as a bank for central banks and coordinates global monetary policy. Their March 2026 quarterly review focuses on the technical developments within international banking and financial markets. Global transaction costs collapsed, with average fees falling from $25 to under 1 cent in 2026. Settlement speeds compressed from a 3-day window to 250 milliseconds. Simultaneously, institutional adoption of digital assets rose from 12 to 62%. The BIS identifies this permanent architectural shift as the invisible transformation. This new architecture replaces the legacy system of physical fiat and analog stores of value. The global market has transitioned from messaging-based banking to token-based settlement. This technical pivot created a new geopolitical baseline, where digital certainty is the primary measure of value, a concept known as the integrity privilege. We must ask how the global financial system mathematically eliminated the 48-hour clearing window. Under messaging-based banking, corresponding banks do not transfer assets instantly. They send text instructions to each other to confirm the availability of funds. Because these instructions require multi-step verification across different institutions, they create the invisible friction, the mandatory 48-hour clearing delay. Consolidation of the asset and the message is what enables a 250 millisecond settlement speed. Traditional banking models that rely on clearing delays or manual reconciliation are now mathematically obsolete. Zero-friction settlement was required for the expansion of an economy no longer restricted to human actors. The catalyst for this institutional adoption is the rise of autonomous AI agents. BIS data shows that over 35% of global cross-border transactions are now initiated by these non-human actors. These agents cannot operate within human-managed fiat clearing windows. Instead, they require programmable money, such as stablecoins and central bank digital currencies, or CBDCs. A CBDC is a digital form of government-issued currency managed by a central bank. Programmable money executes if-then logic the moment specific mathematical conditions are met. This intersection of AI and programmable money created the Code-as-Collateral economy. This logic-driven system replaces the relationship-based analog models of the mid-20th century. Traditional credit scores are now too slow for algorithmic capital, as they rely on periodic human reporting rather than real-time data. The new metric is on-chain reputation, measured through verified identity tokens. These tokens are cryptographic proofs that verify the history and compliance of a specific digital wallet. Modern wealth management now queries the integrity score of a digital wallet to determine creditworthiness instantly. In an AI-driven economy, trust is mathematically proven by the code held within a wallet. These technical mechanics have direct consequences for global macroeconomic power. Sovereign bond markets are now diverging based on the quality of a nation's technological infrastructure. This divergence in the market confirms the integrity privilege. The value of a global currency is no longer tied solely to the reputation of a central bank. Value is now driven by trust in the underlying cryptographic code. Capital is flowing toward nations providing the most secure, legally hard-coded networks. To track this, the BIS uses a nationality view rather than a residence view. It reallocates balance sheets of foreign affiliates to their parent headquarters to show where actual capital control lies. Allocators now look through borders to evaluate the digital architecture beneath. Jurisdictions that continue to use analog finance face a technical penalty. A wealth gap is opening as capital exits these analog systems. Programmable liquidity routes around inefficient jurisdictions in favor of digital protocols with higher integrity. This permanently rewires how global value is stored and perceived. Nations that demand analog compliance are being starved of liquidity. In 2026, the primary sovereign asset is no longer cash, it is code.